Volume. The first concept we will talk about is volume. Now we have already seen volume earlier when we did a couple of lectures ago, especially in the first couple of lectures in this chart patterns and analysis module. When we talked about things like the head and shoulders pattern, we talked about other reversal patterns, then we talked about continuation patterns. So when we did all of this, we always talked about volume as well. Right? We talked about how volume should increase at certain times and decrease at certain times. So really we have seen volume already. So let's now talk about it more formally, and let's talk about it on its own, as I think this will be quite useful. So what is volume? Well, volume is the total number of trades that are made in a single day for any given asset. Right? So if we're looking at a stock, then the volume will be the number of stocks that were traded on that day. We can also have volume for other time periods. For example, we can have weekly volume, we can have hourly volume, stocks traded in an hour, stocks traded in a week. But in general, the most common volume to use is daily volume. Now, volume is treated as a secondary indicator to the price. So when we do technical analysis, price is our primary indicator by which we use to make judgments and make trading decisions. Volume is a secondary indicator. And what does that mean? It means that we use volume to confirm price movements. So if the price is moving in one particular direction, we look at volume to see if that confirms the price movement or it does not. So in that sense, it is a secondary indicator. It is used along with the price, not on its own. And another point to make is that we usually use daily volume, as I just said. We can also use weekly volume. It is usually a good idea to use either one of the two. So if we're looking at a slightly longer term chart, we may have a weekly chart, in which case we would use weekly volume. And one thing I would like to caution against is using intraday volume. So if you load a chart, for example, where it's an hourly chart or something more even shorter time frame, you'll see volume for each small particular time frame. Usually it's a bad idea to use intraday volume. The reason being is that intraday volume varies a lot. So what you tend to see is that in the beginning of the trading day, volume is very high. In the middle of the trading day, volume is quite low, and towards the end of the trading day, volume gets high again. And that's because in the beginning, people like to do their trades right in the start of the day, and then also towards the end of the day, people like to take positions, either that they close out earlier on or take positions going into the next day. So intraday volume can be a bit unreliable in the sense that it won't necessarily tell you about the price movement that much, right? It's more related to when people like to trade rather than actually confirming the price movement. Interpreting volume. Now that we've defined volume and we know what it is, let's talk about how we should interpret it. That is, what should we make of volume figures when we see them? The most important thing to know about volume is that volume should increase in the direction of the general trend. And by general trend, I mean the major trend. I mean the primary trend that we've identified the market is moving in. So, if we have a major uptrend, alright, a major uptrend means the market's primary trend is up. Of course, it doesn't mean the market's going up all the time. It means that its general direction is up, but there will be some days it goes down, some days it goes up, etc. So during this uptrend, on days that the market goes up, we should see volume rising. We should see volume high. On days that the market goes down, we should see volume low. We should see volume falling. And this is how the volume confirms the price. Right? So during the major uptrend, we should see volume rising when the market's going up. That's confirming the up movement. And we should see volume falling when the market's going down. That is, it's not confirming the down movement. So it's only confirming the direction of the major trend. The same thing applies in the other direction. During a major downtrend, that is when prices are falling, okay, the general trend is downwards, volume should be lower on days that the market falls. Volume should be lower on days that the market rises, and it should be higher on days that the market falls. So when the market is falling, then we are moving in the direction of the general downtrend. Therefore, we should see an increase in volume. When the market is rising, we are moving against the major trend, the major downtrend. Then we should see volume falling. Fairly straightforward. The other important point to know about volume is what happens to volume during breakouts. Now, in the last lectures, when we talked about reversal patterns and continuation patterns, we looked at the pattern occurring during a sideways movement in the market, followed by a breakout in one or the other direction. Right? So the breakout is when the price kind of makes its move, when the pattern is complete and the price makes its move. Now, volume can be used to confirm these breakouts. So volume should increase during a breakout. So if we're breaking out upwards, that is, we expect an uptrend, and the breakout occurs upwards, we should see volume going up during that. And this can confirm the movement of the breakout. Likewise with downward movement. And we also want to look at that if there's a breakout in very low volume, then we can be skeptical. So we can use it for the dual functionality. Interpreting volume. Let's now talk about some other important points about volume. So now this we have also mentioned before. We mentioned this in the lectures when we talked about reversal patterns and continuation patterns. Volume is generally more important for uptrends. Now, I did say earlier that volume can be used to confirm downward movement as well as upward movement, and that's true. But what I'm saying now is that for upward movements, volume is more important. So it's more like it better confirms upward movement than it confirms downward movement. And this is because upward moves generally require higher volume to be sustainable. Right? So when the market's going up, it requires a lot of buying interest. Right? And this requires higher volume to occur. In contrast, when markets are going down, it requires selling interest for sure, which would require higher volume. But markets going down are often the result of people getting out as well, right? Which would not necessarily result in higher volume. So volume is generally more important for uptrends. That's the first point. The second point to be aware of is that when volume is not increasing in the direction of the major trend, this is called a divergence. So earlier we said volume should increase in the direction of the major trend. But what happens when that's not the case? Well, when that's not the case, we have a divergence. A divergence can signal a possible reversal in the trend. So if we see a huge breakout to the upside, and we see volume being very low, falling and being very low during that, we might take that as a signal that we cannot really confirm this price movement. It's not very strong. It's likely to go the other way. Alright, so it can signal a possible reversal in the trend. The next important point to be aware of for volume is that the actual level of volume is not that important. So when we are looking at a stock or any asset and we see the volume number, that number itself is not that important, right? Because different stocks have different volumes. Some are very high volume stocks, very popular ones. Some are lower volume. And we can't necessarily compare those two. But what we do want to look at is the change in the volume. So for a particular stock or any particular asset, we want to look at the change in the volume, i.e. is it increasing or is it decreasing? So what's important for us is the change in volume. It's not actually the level of volume. Now there are other methods we can do to interpret the change in volume. So we can use simple trend indicators like moving averages to determine whether the volume is increasing or decreasing. So we can plot a moving average of volume, and this will tell us whether volume is going up or down, right? What is the trend of volume? Because sometimes the individual days might be noisy, so we may want to do this. Volume example. Now what we will do is look at an example of volume on a chart. So here I have the chart, the stock price of Maruti. Okay, and this is starting in May 2011 for 1 year until May 2012. You can see my red pointer here. And I've plotted the stock price here, which is what we are normally used to seeing. And I've also done something else. I've plotted the volume down here. Okay. And that's these blue bars. So that tells you the volume on any single day. This is the number representing it. So for example, this point here would be a volume of 1 million. And I've also plotted this red line here. This is the MA5, which means the 5-day moving average of volume. So why have I done this? Well, I've done this in order to tell us the volume trend. So I know that individual volume days, it's generally quite noisy. We have one-off spikes like that. And that's not necessarily that useful for us. So I've plotted the red line as a trend of volume. It's a pretty short moving average, so it moves quite similarly to the price, and this will tell us whether volume is going up or down during that time. So let's do this. Let's take a look at what's going on here. So let me start in November of 2011. Now we can see here that the price is falling, okay, and during this price fall, okay, when the price reaches is sort of halfway through falling, we see volume start to decrease. Okay, price continues to fall down here, right, coming all the way bottoming over here, and volume keeps steadily moving downwards. So this is an indication that the price should turn back around, because volume is sort of decreasing while the stock price is falling. And then what happens over here? Well, at this point here, we see an upward breakout, right? We see the price go from sort of around here and then have a sharp upward breakout and then have an uptrend as well after that. And we can see this breakout here is accompanied by extremely high volume, right? So volume actually jumps up to here to over 3 million on this day that it seems to have jumped. Stays high, and you can see this moving average of volume follows along. It also goes up. And this should be confirmation of that breakout. So this breakout occurs, right? The stock price increases. Breakout occurs, high volume, stock price increases. And then because it's high volume, that can tell us to confirm that an uptrend may be taking place. And then we can see the price kind of continuing to go up quite a bit. Okay? So that's essentially how we can use volume to confirm price movement. So you can go to any chart yourself and look at it. Just look at, does the volume confirm the price or not? Limitations of volume. So we'll now conclude our section on volume on this final slide, and we'll just talk about some of the limitations of volume as well as some other uses. So the primary limitation of volume is that volume is a secondary rather than a primary indicator. And this is very important to remember, because what this means is that we cannot usually make trades based on volume alone. So we cannot look at the volume of a particular stock price, particular chart, and then make decisions based on the volume movement alone. Right? The volume has to confirm the price movement. So it is a confirming indicator. It is a secondary indicator rather than a primary one. That's one limitation. The second limitation is that volume can be problematic when it comes to analyzing futures. With futures, things get a bit more complicated because we have things like limit days. For example, when there's a very large movement, a limit day means we stop trading for the day because the movement has been large enough. And we might see very low volume in a day like that, even though actually it's a very significant movement. So there are some issues when it comes to analyzing futures with volume. Also, the volume for futures is affected by things like rollover, timings, and all that. We'll talk about futures in the next section when we talk about open interest. One other thing we can do with volume that's quite interesting is to look at what are called put-call ratios. A put-call ratio measures the ratio of put options traded to call options traded. So we're looking at the volume of these options, that is how many of these options are traded. So we could look at how many put options are traded versus how many call options are traded. We know that people tend to buy put options if they think the price is going down. They tend to buy call options if they think the price will be going up. So if we have a high put-call ratio, that means we have more put options traded compared with call options traded. That's a bearish signal, right? It means that the volume indicator is negative. Now, in contrast, if we have a low put-call ratio, that is, we have more call options traded as compared with put options, that's a bullish signal. Right? That means people are expecting the price to go on upwards. So this is something we can do that's quite interesting. Put-call ratios are commonly used, and it is worth looking at if we want to get an idea of what the market is thinking about where the stock will go, based on how the option contracts that they trade. Open interest. So now we've gone through volume. As I mentioned, we are going through these topics quite quickly, so we spent about a quarter of the lecture on volume. The next part of the lecture will be on open interest. Now, open interest is a fairly similar indicator to volume in terms of its implications. That is what we use it for. It is a different indicator, but its uses are similar. So, like volume, open interest is a secondary indicator we can use to confirm price movement. So we use open interest to confirm price movement just like volume. However, open interest is only applicable to futures markets. Alright, and this is important to remember. We can only use it for futures. So what is open interest? Well, open interest is the total number of outstanding contracts at the end of a trading day, okay, or other time period. That means we can have open interest for a week, we can have it by the hour, we can have it as long as we want. In general, we look at open interest on a daily basis. So it's the total number of contracts that are outstanding, that total number of positions that people have, right? So each buy and sell position that exists would be as one contract. That would be one open interest of one. So how does open interest change? Well, let's say we have a trade that takes place, and we have the buyer and seller both are initiating a new position. So the buyer is initiating a new long position, and the seller is initiating a new short position. In that case, open interest will increase by 1. Okay, keep in mind that it doesn't increase by 2 because it's just one contract, right? We have a long and a short on that one contract, but both of them are initiating new positions, right? So there's 2 new positions on one contract, means open interest goes up. Now, if the one party is initiating a new position while the other is closing out an existing position, so let's say now we have a trade where the buyer is initiating a new position, but the seller is closing out a previous position. Let's say he previously had a long position and now he's selling it, closing it out. In that case, open interest does not change because we have half the contract that was closed off and another half that was added. So overall, the number of contracts is the same. And finally, what happens when open interest falls? Well, if the buyer and seller are both closing out an existing short and long position, right? So if the buyer has a short position that he's closing out and the seller has a long position that they're closing out, in that case, when that trade takes place, the open interest will fall by 1. Okay? Because now there's one less outstanding contract. So this is how open interest works and what it is, right? So open interest increasing means more people are coming into the market, more positions exist. Open interest decreasing is when people are closing out their positions. So that's what's important to know about open interest. Interpreting open interest. Now that we know what open interest is, let's talk about how we can interpret it. That is, what does it mean and how do we use it? In general, open interest is interpreted in a similar way to volume, right? So when we talked about volume confirming the price trend, that is the direction of volume confirming the price trend, the same thing applies to open interest. So the direction of open interest, that is which way open interest is moving, can be used to confirm the price trend. So what will happen? Well, if we have a major uptrend, that is prices are in an uptrend movement, going up overall, open interest should increase on the days that market rises. So when the market is going up, we should see open interest increasing. When the market is going down, we should see open interest decreasing. And likewise, during a major downtrend, open interest should be falling when the market is going up, and open interest should be increasing when the market is going down. This is exactly the same interpretation as volume, right? That when open interest increases in the direction of the major trend, that is confirming the price movement. That's what we should expect to see. And likewise, just like with volume, if open interest moves in the opposite direction to the major trend, this signals a possible trend reversal. So if we see open interest falling when the price is going up, and that's the current trend, it could be a sign that the trend is going to reverse itself and go the other way. So that is what we need to know about interpreting open interest. And we'll now talk a little bit about why open interest is interpreted in this way. Interpreting open interest. So when we talked about volume, it was quite clear why an increase in volume could be used to confirm the price trend, right? Because if more people are trading, that is more stocks are changing hands, that means there is more interest in that particular price movement. And that's why we can say that volume can be used to confirm the price trend. But what about open interest? How is it that open interest actually confirms the price movement? What is the underlying logic behind it? Well, when we have open interest increasing, right, and open interest increasing occurs when a trade takes place, and in that trade, both the buyer and the seller are initiating a new position. Alright? So when open interest is increasing, it means that money is flowing into the market. It means that people are putting money, adding funds to this market. Right? So that's the same thing with volume. People are more interested in the current price movement, so they trade more. And that's volume confirming the price trend. Open interest works the same way. When money is going into the market, right, so money is being pumped into the market, it means that people are interested in this current price trend. Right? They believe it's genuine, they believe it's real. As a result, we can expect this trend to continue. Right? Open interest can be used to confirm an existing trend movement. What about when open interest is decreasing? Well, open interest decreasing is the opposite phenomenon. When open interest is decreasing, it means that money is being taken out of the market. It means that investors are closing out positions. Right? So this can be, for example, if a particular level is hit and a lot of stop losses are hit, for example, investors close out. And if this is the reason the price is moving, it's usually not sustainable, because once the investors get out, then what is left to continue moving the price? Right? So if we see open interest decreasing, money is being taken out of the market, that is a signal that the trend will reverse itself as investors come back into the market. So investors may leave the market if they have to cut their losses because stops are hit, and then once the price reaches a favorable area, they'll come back into the market, right? And they'll usually come back in the opposite direction because they left when it was going one direction, so they'll want to come back when it's going in the opposite direction. Another point about open interest that's important to know is that, let's say we see open interest occurring during a sideways movement. So imagine the price is moving sideways, it's not really going up or down, and we see a continued increase in open interest. That means more and more people are taking positions in the market, both long and short. And it means that there's an even balance of the two, because the price is not moving up or down, right? It's sideways. So what's going to happen here? Well, when the breakout actually occurs, okay, it is an indication that a breakout will occur, because it means people are expecting the market to move one direction, in a particular direction. When that breakout occurs, there will be many investors who are caught on the wrong side, right? Because so many people have taken positions, there's bound to be a lot of stop losses that are hit, whichever way the price goes. And after that, when the stop losses are hit, that will exacerbate the price movement. It will continue to go in the same direction. So when we see a lot of open interest taking place during a sideways movement, it will usually imply that a very large move is about to occur because of the fact that stops get hit. So that's just something to keep in mind when we're looking at open interest. Limitations of open interest. Now that we've had a chance to see an example of open interest, I want to talk a little bit about the limitations. That is, when can we, what else can open interest signal? And also looking at other uses for open interest. So normally we said that open interest does confirm a price movement, right? And there is one exception to this. If open interest is very high, alright, let's say we have a lot of outstanding contracts. This can actually be a bearish signal if we see a significant fall in price. So let's say the market's going up, open interest is going up, we reach the top of the market where open interest is very high, right? That would normally be a bullish signal. But let's say at that point we see a drop in the price, right? Let's say a sharp drop that's fairly, not too significant, but a fairly significant drop, okay? Then we could see a large fall in the market. The reason being is that if there were a lot of new positions taken at the top of the market, right? So when the market was at its top and people took a bunch of positions, long positions, thinking the price would keep going up, when that fall occurs, they might have to liquidate, right? You will see a lot of stop losses getting hit and them liquidating the positions, causing an even further drop. Okay, so this is one instance where open interest can give us the opposite signal. So it's important to be aware of it. Now, just like with volume, we can also use open interest to construct put-call ratios. So we can look at the open interest in put options and the open interest in call options. So again, if we have more open put options relative to call options, that is a bearish signal. It means more people are expecting the market to fall. If we have more interest in call options as opposed to put options, it is a bullish signal. It means market participants are expecting a rise. And otherwise, the limitations of open interest are fairly similar to volume. Right? The main one we need to be aware of is that open interest is indeed only a secondary indicator. Right? It is a secondary indicator that we need to use alongside price. Right? We cannot make trades on open interest alone. Alright, that's the same with volume. So we can use volume and open interest both as confirming indicators. Now this of course will only be for futures markets, as well as option markets. You will see open interest on option markets too. I should have said that earlier actually. So open interest mainly to futures and options. And when we're analyzing those, we want to do technical analysis on chart patterns of these contracts. We want to look at it, what it says about the underlying as well, right? So we can look at the option contracts that tell us something about what will happen to the underlying asset. Then, using open interest can be a very, very valuable tool.